And futures are down. Trade worries back in focus. 30 minutes until the start of trading. I am Sonali Basak.
And I'm Danny Berger. Matt Miller and Katie Greifeld are off. Bloomberg Open Interest starts right now.
And coming up, dialing up the pressure. President Trump announces a 30% tariff on imports from the EU and Mexico. Meanwhile, the president and his allies open a new front against Jerome Powell, criticizing his handling of renovations at the Fed headquarters. And the view from corporate America. Wall Street braces for the weakest earnings season in 2 years. Danny, it's crypto, though, that's taking it away today.
It is. If you were looking at risk assets, you'd be surprised to know what crypto is doing today. Trading above 122,000. And all those crypto-linked stocks, they are soaring with that all-time high in Bitcoin. Sonali, Congress currently weighing multiple crypto bills this week.
You know what? We're also looking at M&A. There's a lot going on under the surface, spin-offs and activism. Kenvue is making board director Kirk Perry its interim CEO effective immediately as the company announces a strategic review on the heels of activist interest. But back to this morning's big headline. President Trump threatens that 30% tariff for Mexico and the European Union. However, he's keeping his door open for a deal.
So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. Right now, as you know, they're paying a substantial tariff, but they want to make a difference. So some of these deals, maybe I'll change them and maybe I won't.
For the latest, we're joined by Bloomberg Washington correspondent Tyler Kendall. Bring us the latest and how this is going to play out through the course of this week.
Yeah, hey, Sonali. Well, now that all of these trade letters have been sent out, we're waiting to see how negotiations are going to evolve from here. And of course, the big news over the weekend was that 30% tariff threat against the European Union. And we heard from the EU's trade chief saying that he will speak with his U.S. counterparts later on today. And the EU is going to hold off on its own retaliation until August 1st to let these negotiations continue. But a really key point here is that he went on to say that there is a new sense of urgency, in his words, for the European Union to engage with other trading partners. And Bloomberg News broke the story this morning that contact with other nations, including Japan and Canada, could be used for potential coordination between the nations against the U.S. We know that the EU Commission President Ursula von der Leyen, for example, today is meeting with Canadian Prime Minister Mark Carney. And it's also worth pointing out the EU did reach a tentative trade framework with Indonesia over the weekend, as we expect them to start to sort of shift focus here to perhaps Southeast Asia countries as well as the Pacific. Now, the 30% tariff is, of course, much lower than the 50% tariff that the Trump administration had been threatening. But still, our understanding has been that there was progress in these talks when it came to the European Union. Sonali and Danny, as you well know, the sector-specific tariffs enacted under Section 232 on the grounds of national security concerns really are a big sticking point here. The EU wants to see movement on autos, but I would also point you to the fact that some of these tariffs that haven't even come into play yet, like pharmaceuticals, are still hanging over these negotiations.
Meanwhile, in Washington, D.C. over the weekend, Tyler, it was a White House that continued to step up its criticism of the Eccles building, of the renovations happening there for the Fed. Is this a White House trying to lay the groundwork in order to oust Powell?
So this does seem to be a new argument that the White House has added to their list of criticism that goes beyond the idea of economic stewardship or the demand to lower interest rates. And the president and other members of his administration, including the NEC director Kevin Hassett, as recently as this morning, are elevating this accusation that you're discussing, that the head of the Federal Housing Finance Agency, Bill Pulte, is alleging without details that Powell misled Congress during testimony about recent renovations to the Fed's headquarters here in Washington. This would appear to be setting perhaps the legal basis for a case to remove Powell, which would, of course, have to reach a very high standard. But now you have administration officials calling on Congress to investigate this particular instance. Now, we should say that Powell has said that the renovations were not extravagant, and a Fed official says that all of Powell's testimony has been truthful. In fact, the Fed is actually saying that the renovations are going to help lower costs because it will consolidate their operations. But we do have the latest figures with critics critics pointing to rising costs. The Fed's budget documents show estimates for the projects have risen to $2.5 billion this year, up from an estimated $1.9 billion in 2023. These are the sort of arguments that the administration is now focusing on.
Tyler, really appreciate that update. That is Bloomberg's Tyler Kendall out of Washington. Now, elsewhere, U.S. markets, they will be facing a tough test. Corporate America is gearing up for the unofficial start of the second quarter earnings this week. Big banks will be leading the way. J.P. Morgan, Wells Fargo, Citi, all of them report tomorrow. Joining us with some of the themes to look out for is Bloomberg's equity reporter, Alex Semenova. Alex, what are you looking out for?
Hey, Danny, with stocks trading near record highs, investors will be glued to corporate America's report cards when they begin firing them out this week. Wall Street is actually bracing for the weakest earnings season since mid-2023. Analysts see second quarter profit growth of 2.5%. This is according to Bloomberg intelligence data. The good news is that low bar gives scope for companies to surprise to the upside. Tariffs, of course, will be a key focal point. Analysts don't expect a material impact on company profits just yet, but they will be monitoring guidance to see how executives have handled sporadic tariff announcements. Margins will also be key. BI analysts expect S&P 500 net income margins to hit their lowest level since the first quarter of 2024. The good news is that impact is supposed to be fleeting, with margins expanding again next quarter into 2026. And of course, big tech will be a key focal point among investors. That group is still in the driver's seat. The so-called Magnificent Seven stocks are expected to post a 14% rise in profits in the second quarter. If you take out that group, S&P 500 profits are expected to slightly contract by 0.1% in the April through June period. That, of course, shows the influence that this group has on this equity rally. And AI spending has also kept up, even despite all the uncertainty around trade and macroeconomic conditions. One more important point is a weaker dollar is a welcome development for U.S. exporters. Morgan Stanley strategist David Adams called the weaker dollar a substantial and underappreciated tailwind for U.S. earnings, particularly for the large cap companies. Guys.
Alex Semenova, thank you so very much for keeping an eye on earnings season for us. We'll get more from you throughout the week. Let's dive into earnings more now with Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. When you look at the divergence between big tech and the rest of the S&P 500, how should investors be thinking about what will be hard hit so far in the tariff strategy that we see that keeps changing?
Yeah, it's a really, really tough call at this moment. I think it's been very tough for analysts in particular, where you saw analyst expectations just get crushed over the last 3 months. Most of that was in April and May, and they have yet to really rebound. We've not seen analyst expectations really come back. So there's a really great chance that expectations are very, very low for the second quarter, in particular for the banks, which really kick things off. There was an assumption in the analyst estimates that you'd see some pretty significant loan loss provisions emerge with the second quarter earnings season. Analysts did not take that back. So the banks are expected to post 9% decline year over year in earnings. A really rough earnings season relative to the rest of the index, which is expected to post about a 3% gain.
So a very low bar, something like a 3% gain. We're looking at the most expected weakness from earnings since mid-2023. But Gina, does that even matter if a bar is low, if we're trading at something like 24 times forward earnings?
I think that's a really good point, because you also have this conundrum of a divergence in what's trading so expensively. It really is mostly tech that is trading so expensively in the index, but financials is right there with tech as well. So you've got very expensive valuations, at least compared to recent averages. Some embedded assumption that financials is going to move into sort of a less regulated, more growthy kind of phase over the course of the next 12 months. That combated with a likely beat in the second quarter creates a little bit of a mix. When we get later into the season, tech earnings are going to be fascinating, because this is a space that is expected to basically hold up the index. Outside of tech, expectations are for a decline in the index earnings on a year-ago basis on the second quarter. But tech is expected to really carry a heavy burden. That is also embedded in valuations. The expectations are very high for tech. Unlike the rest of the index, this is a very big outlier. So I think you're going to see a really big sea change as the season progresses, as you move from one industry to the next. Extremely low expectations for reporters in the early part, but much higher expectations as you get closer to the tech reporting.
Speaking of industries that have run up, if we look at the S&P 500, pull up the industries that have been rising throughout the course of the year, you can see industrials, yes, still info, tech, utilities, also materials, getting big run-ups as well.
Yeah.
How will they fare given that they've already been given such a big bid by investors?
Yeah, I think it's been, if you decompose that into what's actually happened in the index, you've got a tale of two worlds. You've got pre-tariff announcements in March and April, post-tariff pause, and now we're moving into the pause is ending. So there's really several phases that have occurred in the markets. If you were to look at that chart back in April, you'd find that tech was a material underperformer in the first part of the year. Then we have pause, the tariffs emerge, the pauses emerge of those tariffs, and that's created a surge back into tech stocks, which have been basically the market's safety play in the pause era. If we go back to a post-pause era, you're going to see a disruption in trends as well emerge again. And I think that that's what we face in the third quarter is now we have tariffs reemerging. No one believes they're permanent. That's very clear in prices. If they become permanent, even for a short period of time, that's a big disruptor into the second half, where expectations are for recovery to emerge for the index at large.
Yeah, you really feel those warnings of maybe it's a market complacence starting to crop up. Gina, thank you so much for joining. Really wonderful to get your take this morning. That is, of course, Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. And a quick look on futures. Yes, we might be concerned. Yes, we might have gotten more tariff letter bombshells over the weekend. But maybe you'd be surprised to know that futures are only down 1/3%. They've been hovering around these levels all morning, Sonali. The NASDAQ down 1/3%, maybe Russell 2000 futures a little bit weaker. It has been Peter Scheer writing a note over the weekend saying that this isn't complacency that tariffs won't hurt equities. Instead, it is a market that is just looking for some de-escalation.
Yeah, and we should remember that the index actually ended last week 0.3% lower as well. So now we are extending some of that negative attitude. Listen, some movers this morning. Really interesting movements under the hood. We're looking at Boeing shares. They are climbing after a preliminary report of last month's Air India crash found no recommended actions to take against the company. Boeing up about 1.4%. And I promised you some deals. This one's a Bloomberg scoop. Kraft Heinz, big news in the consumer sector constantly over the last couple of weeks. Kraft Heinz is preparing to break itself up to combat shifting consumer sentiment, according to people familiar with the matter. And Kraft Heinz only up about 0.8%. Autodesk is another one, Danny. This one's really interesting, up 6% because it's no longer pursuing an acquisition of PTC, also according to sources familiar with the matter. Really fascinating. Sometimes the deals you don't do are worth as much as the deals you do.
And the bankers will still get paid for at least having investigated it. So good news for them. All right, coming up on the show, Elon Musk says Tesla shareholders will vote if it will invest in XAI. We're going to bring you the details next on Bloomberg Open Interest.
And now to high interest, a look at what's making headlines around the world. NVIDIA CEO Jensen Huang said the U.S. does not need to be concerned that the Chinese military will use his company's products to their advantage because they know the risks. Huang says the strategy of restricting technology exports to China will backfire and spur domestic chip growth in China instead. And Tesla shareholders will vote on whether to invest in Elon Musk's XAI. He made the statement in response to an account on X that said the car maker must be able to invest in XAI to be fair to Tesla's retail investors. Musk didn't say when the vote will take place or offer other details. And Google will pay about $2.4 billion for top talent and licensing rights from the artificial intelligence startup Windsurf. This is after the collapse of Windsurf's agreement to be bought by Google rival OpenAI. That deal fell apart because of tension with Microsoft, a major OpenAI investor, Danny.
You know what that says to me? If you're looking at investing in an AI startup, why would you ever do it? If it's really good, Google or someone else is going to come swoop in and take all of your top talent and probably just collapse the company, more or less. Now, we also have some other movers on our radar this morning, and it is all about crypto, Sonali. Look at some of these moves. Coinbase up 1.5%, Marathon Holdings up 3.6%. Bitcoin crossing over the $120 mark. For the first time, the House will debate and possibly vote this week on the Clarity and Genius Acts. Just more things to really solidify the use of crypto. But you already seen some people this morning basically saying, look, it shows that crypto is a great hedge. When stocks go down, you can buy crypto. I'm not sure you can make that argument if it's Congress that seems to be moving crypto and Bitcoin this morning.
A lot could move forward this weekend in the coming months, but also a really interesting statistic about just how much Bitcoin has run up. At the market value that it is breaking into the world's most valuable assets. So that's the top 5: gold, Nvidia, Microsoft, Apple, then Bitcoin. So there you have it, Danny. Hard to ignore.
It's hard to ignore, but the problem is if this thing is volatile, you need shelter from what has been an extremely volatile market. Silver also trading at an all-time high. This is a market that is desperate for hedges. If a dollar isn't working for you, if it's a bond market more volatile, what can you turn to? So it gets this real desire for the crypto bulls to say, hey, we're part of this. But again, history would tell you that the volatility is something that's very difficult to touch.
It's linking closer and closer to the stock market when you have all of these Bitcoin treasury companies listing as well. And so there you have it. We're watching the crypto stocks, but also it's kind of the hot trade in terms of SPACs, mergers, and IPOs. So let's see how long that lasts. We saw the last SPAC boom come and go pretty fast. We're going to talk about high valuations next. Stick with us. We're going to talk about shrinking margins. We're going to talk about normal way companies, not Bitcoin ones, with this earnings season coming up right around the corner. Citi's Stuart Kaiser is joining us next. This is Bloomberg Open Interest. Wall Street is bracing for its weakest earnings season since mid-2023. Strategists say that this is a stock picker's market. Morgan Stanley strategists say that investors should be more selective as views become more divergent. They prefer financial and industrial sectors due to strong earnings upgrades in recent weeks. At the same time, RBC lifted its S&P 500 year-end target to 6250 from 5730, though it remains neutral on stocks for the second half, expecting choppy conditions. Let's now bring in Citi head of U.S. equity trading strategy, Stuart Kaiser, to talk about all these views. But first, I want to show you something we were talking about in the commercial break, just how divergent stocks have been, the ones that are least exposed to tariffs and the ones that are most exposed. Because the ones that are least exposed, you see them soaring, right? And certainly since the April lows, but all year long, almost 20%, while the ones that have been lagging are still down almost 5%. Do you expect earnings season to pick this stock further apart, that the best will do better and the worst will do worse based on the tariff implications?
It's a good question. I mean, last earnings season, about 2/3 of companies said we don't know and kind of left guidance unchanged. So I think, that chart is frankly going to really be driven by what companies say. Do they give us more insight into potential impact on revenue and margins, or do they kind of punt again, and do investors sort of tolerate that? So it's a tough one because you just extended the deadline out to August. So most companies are going to say, they just don't know. In my opinion, I don't think Wall Street should tolerate that again. I mean, I think if you're running an S&P 500 company, you should be able to give guidance on the outlook, and you would expect companies that punt to kind of be punished a bit this quarter. But again, they weren't last quarter. So a little bit of a wait and see. To be fair, I do think tariffs are at this point being treated as a buy the dip opportunity. And I would not expect that really to change at the macro level unless China-U.S. negotiations really break down.
Yeah, even some hard hit sectors. You had Delta come out with guidance. It kind of makes it tough for everybody else, doesn't it?
Well, it's not only Delta, it's Amazon talking about how successful of a Prime Day they had. Stuart, there's been some real resilience among these companies, especially those exposed to the consumer. Is there any reason to believe that would change this quarter?
I mean, not necessarily. Unemployment rate remains pretty low. Job growth remains pretty strong. So it doesn't look like that low-end consumer is being hit that hard at this point. So in that sense, yeah, it should work. But if you go back to Walmart a couple quarters ago, they basically said, in a post-tariff environment, we think our cost advantage is at least as large. So to Sonali's point, there may be winners and losers at the stock level, but that doesn't necessarily mean the low-end consumer is under as much pressure as I think people fear that they might be.
So what does this mean for surprises? What's not being baked into the market today that could come up during earnings season?
It's interesting going into the earnings season. The earnings bar is actually relatively low. You're at kind of mid-single-digit EPS growth, which on both quarter-on-quarter and year-on-year. That said, that bar is actually higher than last quarter. So, there's a lot of moving parts here. What's not baked in? I think what's not baked in probably is companies coming out and saying, we're good. A 10 to 15% effective tariff is manageable for us, and we're leaving guidance where it is, and the consumer is maybe behaving better than expected. So it could be that the right tail is not effectively priced this time, whereas last quarter, I think you might have thought that the left tail wasn't.
But it's interesting, to your point, you had more companies punting than actually giving any sort of guidance or scenario analysis. But Stuart, it wasn't that they weren't only not punished for punting. They were punished if they gave some sort of outlook that suggested that they could be hit by tariffs. If companies don't know right now, what would be even the incentive to give a view into that lens, to say we will be hurt by X amount, if this is a market that is very willing to punish them for saying so?
I think it really boils down to, how much confidence do analysts and investors have in their own ability to forecast. So I think last quarter, people gave companies a pass because they also didn't know, right? Well, people have spent the last three or 4 months trying to figure out, right? So if analysts feel like they have a very good view on the impact on a company's sales and margins, and the companies themselves say, oh, we're gonna keep guidance where it is, I think those companies will kind of be under a little bit of pressure. So I think the risk here is last earnings season, analysts, the Fed, economists, policy makers, I think all had a tremendous amount of uncertainty, and for that reason, you were given a pass. That level of uncertainty is kind of squeezed in tighter now, and I'd be surprised if you were kind of quote given a pass at this point if you don't give a better update.
Stuart, you're going to stick with us. That is Citigroup's Stuart Kaiser. We are about to head into the open. Of course, we are looking at a down day in the S&P 500. Danny, really interesting here. You have the S&P 500 futures not as low as they were a little earlier, but still 0.2% lower. Of course, yields are higher as well today. You have the 10-year well above 4.4%. You're at 443. Risk appetite is not showing up in the market, at least today, ahead of earnings season with sky-high expectations.
Yeah, and those higher yields may very well be the reason why it is small caps that are under pressure this morning that are underperforming. Bonds have a lot going against it, be it some of the concerns out in Japan of fiscal issues, of more spending, something we know is happening throughout the world, and threats coming from Chair Powell.
And I want to clarify, sky-high valuations, but very, very low expectations.
Correct.
So interesting for this setup into earnings season. We have the big banks tomorrow. But to your point here, also, the bond market digesting that Powell news will be pretty interesting because higher yields floating into the market. We've seen this story earlier in the year.
It feels like, though everyone believes for equities, it is just a melt up into the summer. We'll see if any of that changes. We'll continue the conversation with Stuart Kaiser ahead.
And we are moments away from the start of trading. This is Bloomberg Open Interest. I'm Sonali Basak. You are looking at futures lower on the morning as we head into the open. And of course, we are looking then reverse some of those losses. So we could actually open higher potentially. Really interesting morning here. Markets digesting, of course, the tariff strategy on the EU and Mexico, EU's potential retaliation. And we are also watching how markets are going to be digesting pressure on the Fed. There you go, opening bells. You have ADMA Biologics at the NASDAQ, biotechnology being a very hot sector this year. A lot of M&A in that world as well as listings. So keeping an eye on what's going on, a lot of excitement. And over here, over at the New York Stock Exchange, HNR Block. And as we open as well, let's take a look at some of the stocks we are keeping an eye on, Danny, this morning.
Also, does H&R Block have a mascot of like a tax accountant? They could think of something more creative, maybe like an Excel spreadsheet as a mascot or something.
Could belong in Disneyland. That exciting, I don't know.
H&R Block, Disneyland, what's the difference? All right, as you mentioned, Sonali, some really interesting movers. You've been talking about some of the changes happening at consumer companies. Kenvue, it has made board director Kirk Perry its interim CEO that is effective immediately. Shares are up 4.3%. The company has been announcing a strategic review. Again, a lot to watch, a lot of very interesting company news, Sonali. We've been talking about the first half of the year, companies sitting on their hands. Some big changes happening, though, or potentially with what you're looking at, a lack of change and a decision to go against what they originally thought.
Activism, spin-offs, and deals not happening. We're watching Autodesk rise almost 6% at the market open. It is no longer pursuing an acquisition of PTC. People familiar with the matter have said it would have ranked as one of the year's largest deals. PTC down almost 4.5% as well. We are back now with Citi head of U.S. equity trading strategy, Stuart Kaiser, on how to think about this earnings season, but also how to think about positioning heading into it. Really interesting. Liz Ann Saunders of Schwab this morning sharing the CFTC positioning data. I'm wondering what your own positioning data is saying about how funds are positioned. She says she's seeing mostly net short, actually closer to max net short positioning seen in 2022, the bear market. So pretty tough in some places. How are you feeling? going?
Yeah, I don't know. I mean, I think like CTAs and those types that tend to trade futures, those are all max long in most of our models. So we think there's some length there. The way we measure futures flows, at least for the last month or so, you had about 10 consecutive days of pretty solid inflows. Last week was a little wobbly. I don't know. We would put positioning as kind of a modest positive for markets at this point. I think, retail is largely re-risked. I think institutions have largely re-risked. That said, some of the more macro discretionary tactical investors we talk to, when the market's up 50 basis points, they're calling and saying, why is the market up so much? And that suggests that potentially they don't have as much kind of that upside on as they would potentially like to have. So I would never, the pain trade is always lower, don't get me wrong, but it does feel like even a modest move lower will put some pressure on people to get some more risk put in.
I'm sure people are freaking out when the S&P or markets are up 0.5%.
Yeah.
That feels like nothing, Stuart. I mean, what does that say about the event risk that we might have and potentially people unprepared for big moves? We've been talking about earnings, bank earnings starting. You have CPI tomorrow, too. You also have increased continued trade talks. Is there really big event risk for this week? What are you watching out for?
I mean, there's a lot of stuff on the calendar. Whether that stuff is risk, I think, is open to debate. CPI tomorrow, we actually think will ultimately be probably a positive catalyst for markets. Our economists are about 30 basis points. I think consensus is just below that. If you get core CPI around 30 basis points, we do think markets will move higher on that. That'll probably really firm up a rate cut in September. The markets will like that. We actually like small cap stocks going into that. If that's the case, then the FOMC meeting is largely going to be about them messaging the fact that they're going to cut. So that will be sort of a neutral to slightly positive event. And then you get into payrolls and earnings. Earnings, as Sonali mentioned, I think will be a little bit more of a single stock idiosyncratic event. That payrolls report's going to be, very, very important. We're coming off a better than expected payrolls print. If you get another one of those, if you have the unemployment rate at 4.1% and you're cutting rates, I mean, this is a market where equities are going higher, and that's why people feel the pressure to the upside, I think.
So I want to pull up WIRP on the Bloomberg terminal because that's where you have the interest rate probability pricing, and that September rate cut currently has only a roughly 65% chance right now. So for the bold bettors out there, keeping an eye on that CPI to get to that 1% chance of that, or 100% chance of that September rate cut. What does this all mean in context of the pressure that the administration is putting on Fed Chair Powell? How does the market read through that type of uncertainty?
Well, first off, that pressure is not going away. I mean, even if they cut rates, I'm sure the White House is going to pressure them to cut rates further. I was a little surprised by the reaction to the headlines last week. I mean, Chair Powell's been very, very clear that he's not resigning and is not leaving early. I think, the White House putting pressure on him to cut rates we could go back to 2018 and they probably would have had the same conversation. So I don't think there's a ton of new news here. The initial reaction on Friday to some of the headlines does show you that the market is not going to like it if that happens. So, that's important. I think Secretary Basak is very well aware of how the market would react to that stuff. So to me, a lot of this is just more, I don't want to call it stale headlines, but this is headlines that we've heard before. And unless they kind of ratchet up to a new level, I would consider there's just kind of more noise into the market than anything else.
Well, if we were to play scenario analysis, if it does ratchet up to a new level, George Serravelos of Deutsche Bank has talked about the price of firing Jay Powell. He said 3 to 4% sell-off in the dollar, accompanied by a 30 to 40 basis point sell-off in U.S. fixed income led by the back end. What would the impact on equities be if that's what unfolds?
Well, he's braver than me to put a specific number on it.
I'll be brave, Stuart.
Well, look, the bottom line is the Supreme Court basically said he can't fire Powell, right? So what he can do is pressure Powell to just say this isn't worth it. Chair Powell has said that's not the case. So again, I think this is much more noise than it is signal. We do view that long end of the yield curve as a massive important risk to U.S. equity markets. So I think if you were to dislocate the long end of the curve, and by dislocate, I mean you're getting above 5.25 or above on the 30-year, yes, that's going to be negative to U.S. equity markets. From these valuation and positioning levels, you might get a bigger pullback than you might imagine. This is probably like a 1 to 3%, 2 to 4% type event if it were to happen. But again, I think those are relatively low probability, and given the resilience of the market, then the move might even be smaller than that.
Before we let you go, Stu, big message for earnings season for investors right now.
Our big message? I think it's an idiosyncratic risk story. the beginning of the season, obviously this week's going to be banks. To me, that's really a discussion about M&A for a lot of investors. Middle of the season, it's the hyperscalers and what you get from CapEx. It's going to be very hard for them to beat what they did last quarter. So in that case, I think you're just hoping for a neutral, non-disruptive impact. And then third or fourth week, we focus on retailers and what are we seeing kind of from the low end of the consumer. And frankly, I think that third part is really the more important part for equity markets in terms of how much play there is. I think the banks is pretty well understood. I think the hyperscaler spend is pretty well understood. There's a lot of uncertainty about high-end versus low-end consumers. So I would say be patient because you're going to have to wait 3 or 4 weeks to get what is probably the most important part of the earnings season done.
It's a good reminder. It's almost like earnings season never ends. Citigroup's
Joy.
U.S. equity trading head, Stuart Kaiser. Thank you so much for joining us. We're going to get a talk on the stock market right now. Of course, we do have a lot of movement under the surface here. We do have, on a points basis, Tesla leading the gains, but we do have still a fair bit of red on the screen here. Remember, we have been fluctuating into the open, now still down on the morning. We have the big tech companies. NVIDIA is the biggest points drag on the day. Apple, Microsoft as well, right behind it. But you do still have Alphabet higher on the day, as well as Palantir. Let's flip up the screen here and look at the sectors as well to see what's happening. Remember, rates are a little higher on the morning. The 10-year is well over 4.4%. So you are not seeing, interestingly, though, that feed into the market. The real estate sector, financials are actually higher on the morning. They're helping keep this near level as we head into the trading day. We're not seeing major declines on the S&P 500. Communication services is your biggest gainer on the day, Danny, up about 0.6%. Energy is a drag, though, about 0.7% lower.
I gotta say, if you were to tell someone Trump is going to announce major tariffs over the weekend, what happens 30 hours later, you'd probably expect more movement than what you're looking at, Sonali.
Yeah, sure would.
All right. Coming up, another story that we are keeping track of. Elon Musk suggests Tesla shareholders will be polled on whether to invest in XAI. Shares higher by 1.33% for Tesla this morning. We'll have the story for you next. This is Bloomberg Open Interest. You are watching Bloomberg Open Interest on this Monday morning, about 13 minutes into your trading day. And it is easy going for this equity market, despite the fact that we got letters to the EU and Mexico of higher tariffs, despite the fact of all the event risks from CPI tomorrow to bank earnings and continued discussions about those tariffs. S&P, NASDAQ, not as bad as the futures session, down only 0.2%. And check out what's happening with the Russell. Small caps fighting back unchanged, but trying their darndest to go into the green. We also have some top calls for you this morning, some of the analyst action that we are focusing on. First up, CrowdStrike. That gets a downgrade at Morgan Stanley. Concerns about valuation. The firm says it's still a compelling long-term story, but growth is well priced into the stock. Those shares down just below 2%. Next up, we have the personal styling company Stitch Fix. That gets an upgrade at William Blair. That's all thanks to the confidence in the CEO's turnaround strategy. Those shares up a whopping 11% this morning. Finally, wrapping things up with PayPal. That gets a raise at Seaport Global. The company says that tariff-related impacts like slower consumer spending, that they've all turned out better than expected. Shares move higher by 3.33%, Sonali.
Now, Tesla shares in focus in the early trade. CEO Elon Musk suggesting in a post on X that the EV maker's shareholders will be polled on whether to invest in XAI. For more, we're joined by Bloomberg's Global Autos editor, Craig Trudell. And isn't this always the thesis behind Tesla, that it will integrate more and more to the broader ventures that Elon Musk has going on, that AI will be a bigger part of the story? But I think when this initially happened, the shareholders wouldn't expect that would also give them exposure to a large social media company. How is the story more complicated now?
Yeah, it's a messy one, Sonali. I mean, this is a company that we shouldn't forget has sort of been enmeshed in other parts of the sort of Musk universe in the past. You think back to Solar City and how controversial a deal that was, where back then the plan was to turn Tesla into more than just a car company and also a solar company. And, that isn't really something that sort of panned out in a meaningful way. The solar business was quite a letdown for Tesla. But, we've seen this transition now for, call it a couple years of Musk trying to really emphasize Tesla's work on artificial intelligence. So when he was standing up a standalone AI business, there were some investors who sort of cried foul there. And I think there is some concern about, just how much attention Musk is paying to this other business and whether, Tesla should get a cut. And I think that's a lot of what's going on here is investors seeing this appreciation in valuation for XAI and wanting to get in on that.
To that point, Craig, this idea that Musk would be distracted, it wasn't that long ago that this argument came up from Elon himself. Give me more control of the company, of Tesla, or else I move away and concentrate my efforts on XAI. Is that still a concern for shareholders?
I think it is, and this is a guy who's long been stretched thin in very substantial respects in terms of just how many companies he runs. That was made I guess slightly less complicated by combining X and XAI, but just last week it feels much longer already. But Linda Yaccarino stepping back from X and leaving that company, the amount of sort of emphasis on advertising and trying to keep that company generating revenue. And meanwhile, I should also just note that we at Bloomberg have reported just in the last month or so that XAI is burning through roughly $1 billion a month. And so while Tesla investors, some of them are eager to get in on XAI, this is, by no means a company that's generating a lot of revenue and sort of covering its costs as it really tries to catch up in this AI space to the likes of OpenAI.
I mean, dare I ask, you would understand why XAI would have a linkage to Tesla in a lot of ways. But if you look at the valuation of SpaceX, for example, why wouldn't they also want a piece of that, right? If you look at XAI also, do the financials suggest that Tesla shareholders would get a materially higher stock price because of such an investment based on where we are today?
Yeah, I mean, I think it depends on the investor, right? Where, I would say that you think about sort of holding companies and, the old school, like sort of GEs of the world have really fallen out of favor, right? Investors have wanted to sort of place specific bets on specific companies and make sort of cleaner plays. Musk is really sort of going, very emphatically in the sort of opposite direction of the rest of the world, where we've seen a lot of, breakups. But in his case, I think, the fact that he has been so successful in building these fast growing companies and also in being, such a sort of, capital raiser, there's no sort of shortage or lack of interest in sort of getting behind this guy and backing him with more, billions of dollars. And I think, some Tesla investors absolutely see that as these other companies are generating, higher and higher, valuations in these private rounds, they want in on some of that appreciation.
Craig, excellent as always. Thank you so much for joining us. That is Bloomberg's Craig Trudell. Now, coming up, big shakeups in the consumer sectors, the very, very exciting world of Band-Aids to baloney. We'll give you a roundup. That's coming up next. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. Let's get a check on what stocks are doing today because, of course, we have choppy trade underway. We have the S&P 500 still down about 0.1%. The NASDAQ 100 still down more than 0.1%. But the Russell is actually where you see some love today, which is a little surprising because even though you see the 2-year yield marginally lower, about 1 basis point, the 10-year yield is higher, about 4.4%. The dollar is rising just a little bit. We have some stocks with some interesting moves. Of course, we are watching crypto with Bitcoin passing that $120,000 mark. You have Coinbase up about 1.8% on the day. MicroStrategy, a little bit more of a levered play, as you know, up about 3.6%. Autodesk leaving its deal to buy PTC. Autodesk still higher, almost 4%. Danny, PTC, though, down about 1.4%.
Gotta say, a lot of deal news coming in today, Sonali. A lot of it coming from the consumer sector, too. Brands really trying to win over a consumer that, let's say, is being more picky these days. Tylenol maker Kenvue, for example, ousting its CEO in a win for activists. Meanwhile, Kraft Heinz, they're preparing to break itself up, possibly spinning off a large part of its grocery business. Let's Let's get the latest. Shelley Banjo, Bloomberg's managing editor for Global Business, joins us now. And Shelley, what begins with financial engineering also seems to end with financial engineering. Kraft Heinz, if I'm not mistaken, this seems like a breakup to exactly what they were before the two of them united.
Yeah, it's all comes full circle. But this is what they're trying to do now, is to create a good co and a bad co, essentially. So put all the brands that are doing really well in one company and all the brands that are not doing as well in another, or spit it off and sort of dole it out. We're still not sure yet on which strategy they're going to go after.
On Kraft Heinz, it's kind of interesting because you do see the Kellogg deal just a week ago. We see Kenvue, which was a spinoff, now kind of struggling through the latest strategy. What's going on in the sector that's forcing so much change?
Yeah, I think people want to spend money on things that they really want, and the things that they don't want, they're not going to spend money on. And so they're really trying to fight for that sort of market share. So Kenvue was, to your point, a spinoff and has been basically fighting for its life or its existence ever since the moment that it was spun off. So they had activists involved there from the get-go saying, even though you spun this off, there's still, within a bad company, there's still a whole bunch of, good and bad within there, underneath, when you look underneath the hood there.
How many of these companies are just kind of looking at what's happening with the global economic picture and blaming that and saying it is not our fault, it is a consumer that is starting to pull back, it's a consumer that's not picky, and we are simply victims to that environment?
Yeah, I think that's, goes without saying that these companies are going to blame the macro environment. But if you look at some of these individual brands, some are doing better than others. So you've got something like a Tylenol still, doing well. You've got something like Band-Aid that they're actually innovating on making better Band-Aids, but then
How do you improve a Band-Aid?
Pretty
that's classic.
I talk to the Kenvue people and they'll go on about how they've been improving the Band-Aids and it seems to actually be working. But look at a company or a brand like Neutrogena, which is one of Kenvue's brands. They've completely lost the market there as other skincare products go in and take all of that market share from them inside the CVS, Walgreens, pharmacies. So there is work to be done there, and the activists have been in there. They seem to have a plan, and they seem to be executing it.
It's interesting. To your point on performance, Kenvue slumping along since spinning off, but relatively flat. Kraft Heinz, on the other hand, has had a very tough 3 years. It's down almost 30%. It's down about 10% this year alone. What would spinning off certain businesses? They want to spin off a large part of the grocery business we've reported, for example. How would that help them?
Yeah, with Kraft Heinz, you've got a bunch of businesses that are going against the grain in terms of the trends. So you're looking at things like with food dyes and things like that. People are trying to get healthier. They're trying to get stuff that have less additives, less chemicals, that kind of thing. And so that's sort of where Kraft is looking at now.
Shelley, we thank you so much for joining us, of course, covering all things global business. That is Bloomberg's Shelley Banjo, and of course, a lot going on in terms of deals, M&A, activism, and changes at the very, very top. Now we're going to give you a look at what's ahead this week because it's a really busy week. We're going to get the latest inflation print, CPI data tomorrow, plus big bank earnings kicking off with JP Morgan, Wells Fargo, and Citigroup. And remember, the valuations have run up as of late as M&A has been coming back. Bank earnings continue Wednesday with Goldman and Morgan Stanley and Bank of America. On Thursday, we get more economic data with U.S. retail sales, and we also get a read on the media industry when we get earnings from Netflix. And Danny, have you been watching Netflix? Because there's a lot of great content on lately, but people have seemingly been too busy to keep an eye on it.
I would love to kick back and relax on the weekend and watch Netflix, but then we get letters sent to countries about tariffs, and that kind of ruins our viewing. But that's okay. Hopefully we'll get to that at some point. Sonali, quick check on stocks. Here's a good reason why you maybe should just be watching Netflix today and not doing a lot. Look at this equity market, Sonali. It is impervious to the latest machinations coming out of Washington, D.C., down just about 0.1% for the NASDAQ, and it is a Russell 2000s index that is moving higher.
So interesting. Russell moving higher on a day like today while the others are down. But I will say something interesting about all this is that Stuart Kaiser saying that investors are sneezing at a 0.5% move in the S&P 500. So maybe that 1/10% matters a little bit like today. Now, coming up in the next hour, Nancy Tengler shares her top 5 stocks for the second half of the year, plus Deep Isolation CEO on the nuclear power renaissance. This is Bloomberg Open Interest. And we are 30 minutes into the trading day, and we are looking at losses on the S&P 500 and the NASDAQ 100, both to the tune of 0.2% lower. The 10-year yield now around flat, but still at 441. Welcome to Bloomberg Open Interest. I'm Sonali Basak.
And I'm Danny Berger. Matt Miller and Katie Greifeld are off today, and maybe it's a good day to be off, Sonali, despite everything we got over the weekend, despite event risk from trade conversations to CPI tomorrow to bank earnings. It is an equity market that has barely moved.
Generally on hold, a lot coming up, and coming up next, dialing up the pressure. President Trump announces a 30% tariff on imports from the EU and Mexico. But as you've been saying, Danny, not floating through to the equity markets all too much just yet.
Meanwhile, the president and his allies open a new front against Jerome Powell, criticizing his handling of renovation at the Fed headquarters.
And the view from corporate America. Wall Street braces for the weakest earnings season in 2 years. And that's as investors await that big earnings test. Laffer Tengler is opening up its playbook. CIO Nancy Tengler says she remains long technology and thinks the tech trade will continue to drive stock performance. She's focused on the regime change names in AI, robotics, quantum, and nuclear. Nancy joins us now. I know a man that's looking at some of those trends too, and his name is Elon Musk. Nancy, I want to point out the moves that we're seeing in Tesla today in particular. Notwithstanding earnings season, we'll get to that. But what do you make, knowing that you have been in this stock, about the potential to invest in XAI? Is it a necessity? Is it something that will add to the valuation, and how much?
Yeah, well, thanks for having me, Sonali. So I guess I would say the following. Tesla has a unique shareholder base. They are loyal, they are rabidly loyal, and they are retail. Now, clearly institutions own the stock as well, but at the margin, I think retail investors drive the sentiment in the stock. And I sit on some of the podcasts they host, and what they have been talking about is how they wanted to get access to XAI. So this may in fact be a positive for the stock long term, and I think it bodes well for the whole notion of participating in regime changes, because if you think about what's going to drive the future, 450,000 or almost 500,000 manufacturing jobs unfilled. What's going to fill them? Robotics. And robotics is driven by AI, but it's also driven by the expertise behind XAI. So I think this is interesting. We have a precedent in 2016 when the company integrated, if you will, Solar City. It was unpopular. There were lawsuits, but the stock went up subsequently, and they won the lawsuit. So stay tuned.
Nancy, the other theme it highlights is something that you argue and have been arguing, that retail money is the smart money. And I think that is perfect, because if you tried to fight the dip buying that retail did at the start of April, you would have been punished. How much of what we're witnessing in this market right now is that Pavlovian urge to buy the dip and saying, hey, retail was right last time around to fight, to push back any of the losses. Why not do it again?
Well, and Danny, importantly, there's $7 trillion in cash on the sidelines. So what you have is during earnings season, you have the stock buyback desks on hold. Institutions have still not stepped in. I've been watching your show religiously, all of them for weeks, and I hear the well, we don't believe in the rally argument. I don't understand that. I had a guy say to me once, I don't believe in dividends. And I was like, well, it's not a religion. It's just a fact. And so we were in, buying in late March, early April. We didn't know anything that anyone else didn't know. But what we saw was dislocation in a number of the leaders, like the Microsofts and Palantirs. And so we added to holdings, and we're pretty happy we did. I think retail investors are going to continue to put money to work. And I think that we have not yet seen or really fully understand the benefits of we call it the Obama bill, but the great one big beautiful bill. I'd just like to call it the tax cut bill and benefit for industrials bill, but that doesn't ring as true.
Some areas that have been benefiting from the administration's moves include financials. And Nancy, I understand that one of your top picks is actually Goldman Sachs. I think that's such an interesting one because if you compare Goldman, Morgan Stanley, and JP Morgan, Goldman is just hitting 2 times book value in terms of its own valuation, but it's still cheaper than the other two. How much is valuation playing a role in the stocks that you're picking in the financials, given the run-up that we've seen this year?
Yeah, so that was a member of our 5 for 25. Sonali and I revealed that on December 31st. We still like the stock very much. As you know, it's run quite a bit. We are light on the banks. The only other bank that we own is JP Morgan. And then we've expressed our financial exposure through names like Brookfield Asset Management, American Express, Visa, some of the sort of ancillary aspects of the financials. I think that these names may take a break, though Goldman has the benefit of the deal making and deal flow narrative, which we expect to see accelerate in the second half of the year. I understand that Morgan and JP Morgan do as well, but I think Goldman trades off of that more than the others. And so we're going to continue to hold here. We may have to trim back due to outperformance and outsized positions in our portfolio, but that does not mean we're not committed to the name. I think this is one you want to own, and you can still buy it here and I think be happy in a year or so.
Nancy, are you still going to be dealing with, again, overexposure, needing to trim back when it comes to tech? I know it's a sector you really like. As you were just explaining with Elon Musk and Tesla, you're really tuned into various robotic themes. But do you face the pressure of a sector that's been carrying a lot of the weight so far?
Yeah, Danny. And that's what you have to do as a portfolio manager. So we're actually trimming this week. We trimmed a little bit a few weeks ago. And that's been consistent. Like every kind of July, we've seen these things run up for the last 3 years. We've trimmed them back, and then we've had an opportunity to buy them again in the fall. We run very low turnover portfolios, but you have to take some off the table. I mean, in our TGLR ETF, Oracle is something like 6.8%. So we're going to be trimming that back. We still love the story, but you have to. Otherwise, the market makes your asset allocation and stock selection decisions for you.
Nancy, before we let you go, I want to ask you about the mounting pressure that the administration is putting on Federal Reserve Chair Jerome Powell. What do you make of the latest pressure and any potential threats to his current tenure as chair?
Yeah, so Sonali, I've been on your show. I've been critical for years of this Fed. And really, I wrote a piece a couple of years ago that said it's time to replace the Fed with ChatGPT, because at least ChatGPT learns from its mistakes. I think that is the hallmark of this Fed. They have not learned from their mistakes. So Trump 1.0, we saw a hike in rates from Chairman Powell. Due to tariffs, they weren't inflationary. Then we saw him wait too long on cutting rates, and now we saw him cut early, and the market responded to his 100 basis points cut by driving up the yield on the 10-year 100 basis points. So I think this is a Fed that's lost credibility. I don't love the idea of the administration putting pressure on an independent body, but the flip side of that is they've done a lot of damage to the low-income cohort by allowing inflation to really run. And we didn't hear any complaints about profligate fiscal spending from the Fed and re-regulation of the economy, but we are hearing now they're worried about tariffs. I think they should stay out of the policy business and pay attention to the economic business and the mandates of the Fed. So I don't know what the market will do, but I don't think the market is hanging on every J. Powell word as it used to.
How would you trade, Nancy, if indeed he is no longer the Fed chair? There's no indication, of course, that would happen. But if he was no longer in the position, what changes for you and what would you do?
Well, I think the market will discount that ahead of time. So you've started to see a little bit of the 10-year yield coming in somewhat, although it is bouncing around. But it is surprising that the yield isn't higher given some of the rhetoric. So I think what we've done in our portfolio is as rates hover around this level, the 10-year I'm specifically referring to, we've extended duration, and we will continue to do so if we get a pop in the 10-year. And then in terms of what we'll do with stocks, I think all of this is very good for stocks. A very slow easing cycle has always been bullish for stocks. So whether we get a cut in September or later in the year, I think it's still going to be bullish for stocks. Remember in the 90s, and I've drawn this analogy for 3 years again, we had a 5% Fed funds rate, a 7 to 8% 10-year, 3% inflation, and robust stock returns all throughout the decade. So I think stock investors are in good shape. Bond investors are just going to have to be a little nimble.
Ouch, Nancy. At least ChatGPT learns from its mistakes. Harsh this morning. That's why we love you, though. Nancy, thank you so much for joining. We always appreciate your honesty. Laffer, Tengler, CEO and CIO, Nancy Tengler. All right, let's look at some of the individual stocks that are moving this hour. Bloomberg's cross-asset reporter Denitsa Tetskova joins us now. Denitsa, kicking us off with some of the crypto stocks this morning.
Let's start with crypto. Coinbase is up 2%, and it's up 60% year to date. Pretty much every crypto company you can think of is up. Circo, Mara, Riot. It's really one risky bet that has been doing quite well, as you see major stock indices obviously stumbling. Currently, Bitcoin is above 120,000. It's a relentless rally. Of course, what's happening in Washington plays a very important role. The so-called Crypto Week is beginning. There is important legislation moving to the U.S. House of Representatives. There is a lot of institutional demands. There is a very strong retail demand. We saw what's happening on ETF fronts. One of the strongest inflows since those ETFs were launched. Obviously, legislation is moving very fast in D.C. and really one of the strongest trades this year. Bitcoin is up 30% year to date, and a lot of companies around it are benefiting.
So get this, if you have Bitcoin up 30%, Coinbase up almost 60%, Robinhood up almost 172% this year.
Incredible.
So the only thing better this year than betting on Bitcoin apparently is betting on stocks and Bitcoin. So really interesting. Also betting on M&A. You're watching
Exactly.
Autodesk. I think this is really interesting, the anti-M&A story.
Very interesting, Tate. Autodesk up 4% after it said it's no longer pursuing the acquisition of PTC. PTC is actually down, so very interesting trade. Obviously, since the news broke out of that acquisition, we saw the company Autodesk tumble 10% just in a matter of a few weeks. So clearly, investors are viewing this as a good development. A type of the two companies would have ranked into one of the biggest mergers this year, but obviously for now it doesn't seem that's happening. In a regulatory filing on Monday, Autodesk said it remains focused on executing its strategic priorities, including allocating capital to organic investments. It did mention PTC, and it's also said it continues its share purchase program. The company is about flat this year, but obviously today we're seeing big relief after a few weeks of kind of a lot of pressure on the stock, a lot of downward pressure.
Speaking of some downward pressure, Rivian down 3%. Denitsa, what's going on there?
It's coming off DC, of course. We have the beautiful bill moving, obviously signed into law, and that's where the EV credit is playing an important role. And Guggenheim downgraded Rivian to neutral from buy. The EV credit is obviously up to 7,500. That's a big amount. Sales are already slowing in Rivian, so that puts a lot of pressure. The company is down 4% year to date. We also have some legislation about emissions and that potentially some of those credits going away in California. So a lot of pressure.
Denitsa, we thank you so much. That is Bloomberg's Denitsa Sekova in with the big movers. And tomorrow, more big movers. Big bank earnings kick off this week. My spreadsheets are getting dusted off. JP Morgan, Wells Fargo, Citigroup, all tomorrow morning. We're going to bring you what to expect in the Wall Street beat. This is Bloomberg Open Interest. And now to high interest, a look at what's making headlines around the world. President Trump is criticizing Federal Reserve Chair Jerome Powell's handling of an expensive renovation of the Fed's headquarters, which has a price tag of around $2.5 billion. Axios is reporting that Powell has asked the central bank's inspector general to review the project. And the slump in Japan's long-term bonds intensified today. Yields on Japan's bonds from 10-year to 40-year spiked amid signs of thin liquidity and increasing worries about higher government spending. Remember, this has been the decades-long carry trade. We're going to be watching those Japanese bonds to see what the implications are. We're also watching a very hotly watched story on Wall Street. Jane Street deposited $564 million into an escrow account to comply with an order from India's securities regulator. It's part of an ongoing probe into allegations of market manipulation by the U.S. trading giant. The firm denies those allegations. And earnings season kicks off this week with the big banks first out of the gate. All 6 of the U.S. lenders are forecast to show increases in trading revenue. That's the focus of today's Wall Street Beat. Today, joining us is Allison Williams, Director of Research for the Global Strategy Team at Bloomberg Intelligence. And the big banks set the tone in a lot of ways, don't they? But you have a lot of things to watch between trading revenue and M&A at the big investment banks, but also net interest income. Let's start with net interest income. How much is Main Street supposed supposed to be fueling returns for these banks over the next several months?
So I think that there's a cyclical aspect and a structural aspect, and I think if you look at net interest income, you should see an acceleration as we go through the second half, and that sort of makes up for some of the seasonal decline that we'll see in trading. Trading has really been a fuel for the big banks. We think it's a fuel this quarter, but seasonally that should fade a little bit. And I mean, just taking a step back, I think that the most important thing to think about as we come into this quarter is that there is uncertainty in the second half. There are risks, but really the environment has improved a lot. If we think about in April, Sonali, as you know, when they reported results, at that time there was something like 65 to 70% of recession being priced into the Bloomberg prediction markets, close to 4 rate cuts. Now those numbers are closer to 20% odds of a recession for 2025 and 2 rate cuts. So when the banks looked at that environment a few months ago, they said, look, things are volatile. We're not going to make big adjustments. And so to some extent, we expect their guidance, could be stable or with a bias to the upside. But analyst estimates, we do think, did factor in some of those rising risks. And so we think that, I wouldn't say it's a low bar, but I would just say that we think the results come in good. But even though sell-side analyst estimates, give you one number, the stocks have really done very well. And so I think they're anticipating a lot of what I've just spoken to. So the sentiment has improved, risk has been reduced, but the stocks seem to know that.
Even so, it is investment banking results, Allison, that continue to underperform. It's expected to be the 14th quarter in a row where investment banking is less than a quarter of revenues for this industry. Is there any reason to believe that might start to change?
Well, I think if you think about structurally the global investment banking revenue pool over time, a rule of thumb would be that, FICC is half of that. Equities trading is a quarter of it, and banking fees are another quarter. If we go back and look at, a couple of years ago, sort of the highlight, when we were hitting on all cylinders with investment banking fees, and we had, record for, M&A and equities, debt has really continued to be strong since then. I would say they had a very strong year since then. Since we had the strength a few years ago, we're continually looking for, okay, when are we going to get back there? So we think there's, opportunity for improvement, but we also think that really set a high bar. And so a quarter of the revenue, I would say, is pretty typical. Now, I think why investors focus on that so much versus trading, right, is that it is a higher return business. So investors do focus on profitability, so not just revenue. And so that's a capital light business, as we like to talk about. And we have been waiting for that recovery. We did see good growth last year across the business lines. We saw a stall in April, and then we've seen a pickup. So I think you could get potential for some surprises on the equity fees, on equity underwriting, right? And we did have markets, hitting global highs. The global equities index, as well as global market cap hitting record highs. So I think that is helpful to the outlook for those fees, but it will be tough to, hit the high watermark that we saw a couple of years ago.
Allison, we thank you so much for walking us through what to expect. Stay with Bloomberg for full coverage of this week's bank earnings. Tomorrow, we're going to get you analysis from Baird senior analyst David George. I'm going to be joining Danny Berger in the 5 a.m. And so it's going to be a long day as we digest how these banks are actually doing, Danny.
And look, are we going to get more warnings from the likes of Jamie Dimon? He's already been talking extensively that we're complacent on tariff risks. It's hard to look at the market and argue otherwise. But how much is that reflected across Wall Street? How much is that reflected in their business? Allison talking about a bar that's kind of low, but not that low, expectations getting better. Yeah, it's going to be a long day. A lot to go through.
Speaking of expectations, take a look at these markets. We were down on the day. The S&P 500 is now trying to knock on to positive territory. You do still have it roughly flat on the day, but near session highs. NASDAQ 100 is up 0.1%, and the move in yields, the rise in the 10-year now calming down just a little bit. It's now at 441. It was around 443 when we started the show. So really interesting moves in the bond market. The financials, of course, very tilted to that move in the bond market. We will see, in addition to that economic forecast, the weather forecast, right? Everyone's looking for that Jamie Dimon weather forecast. In addition to that, we'll just see if they can make more money with yields where they are. Stick with us. We're going to give you more markets. Up next, we got a lot going on. This is Bloomberg Open Interest.
Mike Wilson over at Morgan Stanley has been arguing it is a stock picker's market this earnings season. Just looking at today, it's hard to argue against that. Not only is it a stock picker's market for sectors, even within the sectors, we're getting some big differences this morning, which is odd. Almost even numbers of moves higher versus lower. But look, you look at Apple, down 1.3%, but at the same time, Meta does better and Netflix does better, even within tech. You can't get a clear picture this morning. It's a lot of event risk. It is bank earnings, it is trade headlines, it is CPI. So you get a market that is trying to figure out what to do. Maybe the move is to sit on your hands. On an overall market level, you're looking at little change this morning. But consumer comms companies are up while infotech is down. Energy down a whopping 1.2%, despite the fact, Sonali, oil isn't moving a lot. And at the same time, again, it is earnings coming up. Maybe that will be the focus that dictates where this market goes, Sonali.
Yeah, certainly people are watching the energy sector, and they're also watching the energy sector outside of oil, which brings us to what we have coming up next, America's nuclear renaissance. We're going to speak to Rod Baltzer. He's the CEO of Deep Isolation, the first company to commercialize nuclear waste disposal. That's next. This is Bloomberg Open Interest.
Nuclear, I'll give you 2 weeks for approval. A coal-fired plant, you only get a couple of days. And oil and gas will give you a week, okay? Something like that. But he's doing it so fast, and we have so many plants being built right now. It's so beautiful to see. And one of the reasons they're coming here is because they have to produce tremendous, especially the AI, they have to produce beyond believable amounts of electricity.
President Trump turning to nuclear power to help power America's future. In May, the president signed 4 executive orders aimed at re-energizing the country's nuclear industry. The push sending nuclear-related stocks into the green this year. Enter Deep Isolation. They're the only commercial company in the U.S. looking to safely store nuclear waste deep underground. Joining us now, Rod Baltzer, the company's CEO. Rod, first explain to us how exactly this works. When Americans are expecting more nuclear power to be expanding throughout areas in the United States, where does the waste go, and how is what you're doing different than what has been seen before?
Yeah, so typically what has happened in the U.S. is they've taken this spent nuclear fuel out of the reactor pools and they've moved it into dry casks. It's all stored above ground. Nobody has ever disposed of it anywhere in the world, and we've been producing nuclear power for 70 years. Deep Isolation's technology is, let's put that in a canister that we can put in a borehole, similar to what we use with directional drilling, deep underground, a mile underground, and permanently keep it out of the biosphere and away from people in a very safe configuration.
Rod, the fact that something like this isn't being done right now kind of scares me. Should it scare me? Is it a problem that we're not using technology to bury this type of waste deep underground at the moment?
No, you should not be worried. Nuclear handling and storage is something we do very safely, and most Americans live within 50 miles of nuclear waste storage. They just don't realize it, and it's because there's just not accidents or troubles with it, and it's handled very safely. But we can do better, and we should do better. And this is costing American taxpayers billions of dollars, and we need to stop that and just do the right thing.
Now, how costly is this process, and what does it mean for Deep Isolation and your own funding needs moving forward?
Yeah, so we've done a lot of economic studies, and we're about half the cost of this typical mined repository that countries have been trying to develop for over the last few decades. And so we can be much more cost effective, and we can deploy modularly. So you could put this at a reactor site and not have to transport the fuel anywhere. So we're working hand in hand with a lot of the new advanced reactor companies and trying to make sure that they're thinking about the back end as they do the front end. One of the things Deep Isolation is trying to do is get funding for a full-scale at-depth demonstration. Our nuclear clients and customers are not experienced with oil and gas and how sophisticated that can be. And our oil and gas partners are not as sophisticated in nuclear handling and how safe that can be. And so we're marrying those two together. And we just need to kind of show this all work so people can come out and kick the tires, so to speak.
Rod, it's kind of remarkable to be having a conversation like this when it wasn't that long ago. It was only a few years ago, this idea that nuclear energy and the demand for it is being left for dead. It seems like it is AI that has revived the sector and the demand for it. But still at the same time, only 2 new traditional reactors have been added in recent years in the U.S. None are in the works. Realistically, does that change, or is a lot of it just hype right now?
No, I definitely see it changing. And, this is AI data centers and just, progress that we make every year. And so the need for electricity is real. We've tapped a lot of other fuel types, and nuclear is a very consistent baseload, steady producer. And so it is something that's clean and you can add it in there. It's not has been. It takes a long time to develop, and it's expensive. So if we can start producing these more regularly, like we used to, I think that drives the cost down and it really opens that up. But we also need to make sure we're planning for the whole life cycle. And so we do the whole thing. We can do that here in the U.S., and we should do that again.
I also want to point to another force in your favor, which is just law, right? Because you have the Supreme Court leaving intact a plan to store as much as 40,000 tons of highly radioactive waste at a site in West Texas as one big example of a wind towards your industry. What kind of difference does the Supreme Court decision make?
It's an interesting decision. So it basically said that the NRC can license this facility, but I think everybody in nuclear also knows that the state has to get on board. Texas has been very opposed to that. They've been very vocal about that, and we can't force nuclear waste onto somebody who doesn't want it. And so that's the kind of purpose for deep isolation. You don't have to have one centralized repository where all the waste in the nation is going to go. You can do it where it's just your reactor. So as you benefit from those jobs, that property tax, those economic incentives, you also can take care of that waste. It doesn't have to sit there above ground in storage for 100 years and not really know when it would ever be taken away. You can put more of this back in your own control.
Hey, Rod, thank you so much for your time this morning. That is Rod Baltzer of Deep Isolation. And speaking of new energy, be sure to keep it here for coverage of Bloomberg Green. It is a conference which brings together leaders to explore climate solutions for action, and it kicks off this afternoon in Seattle. Now, speaking of various green technology, we go live to DeSoto, Kansas, where Bloomberg Tech co-host Ed Ludlow is reporting on the opening of Panasonic's new EV battery factory. The factory is the largest ever to be built by Panasonic. It's in its 107-year history. Tesla also happens to be Panasonic's biggest battery customer. Ed Ludlow joins us now from Kansas. Ed, what does it say about this moment in time to have Panasonic investing this type of money in an EV batteries?
Well, it's a full-on commitment to supply. The question is whether or not demand is here. 30 gigawatt hours per year with these little things. This is a 2170 cell. And this facility is capable of building enough of these little guys for 500,000 EVs per annum. There was a report out of Japan from Nikkei Friday that Panasonic is going to delay ramping this facility to full capacity because the demand's not there on the EV side. Panasonic put $4 billion into this site, but they also got almost $7 billion from the Inflation Reduction Act and the benefits that it offered, as well as state subsidies. This is the biggest economic project in the state of Kansas's history. So there are lots of questions, but it's very interesting to look at the economics of a battery cell that's made here that goes into an EV made in America, either by Tesla or also by Lucid, versus a cell that's imported from Japan or elsewhere. And what I keep hearing is the economics are much better. Of course, a part of that formula is that a cell that is manufactured here isn't subject to tariffs. These are the kind of conversations we're going to be having in about an hour's time.
I also want to get your view here, Ed, because, of course, you watch Elon Musk and every one of his moves so closely. You reported so recently on the most recent SpaceX funding round. What do you think this is going to do for Tesla to have the shareholders vote on that XAI investment? What changes?
Right, so I've spoken to a lot of investors in the last 48 hours. We confirmed that SpaceX did put $2 billion into XAI as part of the $5 billion equity portion of the $10 billion it did at the end of June. That was confirmed by Morgan Stanley. What Elon Musk is going for here is some kind of vertically integrated AI stack. So the way that you think about it is, yes, Tesla gets Grok. Okay, and we know that Musk says that Tesla will now vote on the company investing into XAI, likely to happen November 6th at the company's 6th annual shareholder meeting. But think about how this all works. XAI brings the models. Tesla also provides compute. It has a lot of data center capacity alongside NVIDIA GPUs. And when we talk increasingly about inference, the running of these models, that's where SpaceX and Starlink comes in. You basically have constellational space-based data center capacity on the inference side. So what I'm hearing is that there's no plan to have some kind of single entity conglomerate, but just to more formalize and codify how all of the different arms of Elon Inc. work together. That's what the play is here.
How much of this, Ed, is also just about this intense race companies are doing to try to beef up their AI offerings, with Google stealing a lot of the top talent from Windsurf? How much of this is just a race to get all the dollars and all of the talent?
Yeah, I mean, Elon Musk actually posted on Friday when we reported that XAI is doing a quick $10 billion follow-on raise, that they don't need capital. But that actually conflicted and contradicted with the reporting that was based on the shareholder decks that went out on the debt offering, that the company's burning more than $1 billion a month. They moved really quickly with their Memphis data center, Colossus, but moving quickly often requires capital. So that's part of the story here. Talent is an equation there. You saw during the unveiling of Grok 4 that Musk has put together quite a deep bench of talent on the AI side. But again, it's bigger picture. It's what does XAI need? It needs capital, but it also needs a mechanism for Grok. You already had it with X, formerly Twitter. Now you're going to get Grok in your cars, a way for people to interact with it.
Ed, we thank you so very much. We're looking forward to your interviews today. That is Ed Ludlow reporting from DeSoto, Kansas. And next hour on Bloomberg Tech, catch Ed's interviews with the CEO of Panasonic North America and the interim CEO of Lucid Motors. Now let's get a look at some stocks moving at this hour with Denitsa Seikova. We've been keeping an eye on Boeing this morning.
Yeah, Boeing shares are up slightly today. General Electric is also up today. It's coming after preliminary investigation about the Air India crash, saying that it will not require them to take actions over Boeing or General Electric. We're seeing some also upgrades for Boeing. It's coming from Bernstein and Citi. The company is actually up 30% year to date. Really big change of fortunes compared to last year. Obviously, there have been so many accidents and the climate has been very difficult for the company. It was also the winner of the next generation US fighter jet. So far that momentum stays. And of course, these are only preliminary results of the investigations. But another stock that is doing well this year, but is suffering today, is SoundHound AI. Shares are down 5%. It's coming off a downgrade from Piper Sandler. I mean, the main thing is the stock is on a meteoric rise. It's been up 60% since the April low. The company's Piper Sandler is saying that the company is trying to achieve profitability and at the same time invest into their AI platform. And of course, doing those two is very hard. That said, it's not a negative outlook. They're saying in the second half they may do quite well. So obviously it's coming off a very expensive stock. Another Piper Sandler downgrade, it's coming for Best Buy. Stock is down 2% today. But that's a very different story than SoundHound AI, because the stock is down 18% year to date. A lot of pressure. We saw obviously Prime Day doing very well. Things are not looking so well for Best Buy. That obviously boomed during the pandemic, and since then it has suffered. Last earnings season was a difficult one. They've been trying to reduce exposure to China. That's taking some time. They reduced its sales and profit outlook. So that's one retailer where analysts are clearly not seeing so much optimism so far.
All right, three of the names to look out for this morning. Denitsa, thank you so much for your time. That is Denitsa Tetskova. Now, coming up, President Trump and his allies have seized on an a new way to criticize Fed Chair Powell, and that is the renovation of the Eccles building of the Fed headquarters. We're going to have more on that next. You're watching Bloomberg Open Interest. Fed Chair Jerome Powell in the firing line from Trump's economic allies over the weekend. White House National Economic Council Director Kevin Hassett told ABC that the White House is exploring firing Powell early.
Yes or no answer. Does the president, in your view, have the authority to fire the Fed chair?
That's a thing that's being looked into, but certainly if there's cause.
Joining us now is Stuart Paul of Bloomberg Economics. Stuart, all this surrounding the criticism on the renovation of the Fed building, is this real? Is this really the White House laying down the groundwork to oust Powell early?
That's really what it looks like. It looks like the discussion around the refurbishing and the renovations at the Federal Reserve's headquarters in Washington really are mostly just cover for two other more important motivations for the administration. The first is that they often accuse Fed Chairman Powell of being too late to hike rates, and now too late to cut rates to extend the economic expansion. The second motivation, of course, is that the president, we've heard, has said that he wants to see lower interest rates so that he could have lower financing costs on the national debt. And all of this discussion about the renovations for the Federal Reserve's headquarters are just cover to apply additional political pressure to Chairman Powell.
Legally, though, what's possible?
Firing the Fed chairman for a cause is legal and plausible under the Federal Reserve Act. Putting political pressure on the Federal Reserve chairman to then step back if he felt as though he lost power, that's something that's plausible as well. We saw even Chairman Volcker eventually resign when he felt as though he was being outnumbered and losing control of the Federal Reserve Board. That's not a legal tactic, that's more of a political tactic. And we will see an opening come up in January where the president can appoint someone to fill Governor Kugler's current seat. That could be that shadow Fed chair that could be applying some political pressure, making Chairman Powell lose control. But we do know that there's no such thing as a free lunch in economics. The one thing that is closest to that free lunch is having a politically independent Federal Reserve that can deliver lower, stable inflation and longer economic expansions. Succumbing to political pressure is undoubtedly a bad thing for the broader macroeconomy.
You know, Danny, it's kind of uncanny how many parallels there are from now to, first of all, Volcker, one of the most historic Fed chairs of all time, to the Volcker era, given the 70s era of prolonged inflation.
And we know Powell is someone who has looked up to Volcker and talks about his steadfastness. And maybe that's what Powell wants too, but the question I think needs to be asked, and this is something Neil Dutta has talked about, Stuart, this idea that if you get an appointment, an early exit, and you get a political appointee, they might be Fed chair in name only, that it is a committee, and the committee will push back against the Fed chair.
Is the name Kevin?
It could be one of the Kevins, Stuart. If it is one of the Kevins, is it a name only, a Fed chair? Is it a committee that pushes back against a blatantly political type of appointee?
I think that it depends on who ends up filling the role. I think that if Kevin Warsh, for example, were to fill the role, he would almost certainly be a Fed chairman in name only, with a lot of pushback coming from other members of the committee, other members of the Board of Governors, and the regional Federal Reserve presidents. I think that if you were to see someone with a little bit more institutional credibility, let's say Chris Waller getting nominated to fill the chairman's role upon the expiration of Jay Powell's term, that carries a little bit more weight, and he does have a bit more of a dovish bias and could deliver a little bit more of what President Trump wants. So if somebody has the institutional credibility of somebody like Chris Waller, they could truly become Fed chairman and fill a real leadership role. If we were to see someone who's now effectively an outsider, who's been lobbying for the role, who would be under the thumb, let's say, of the administration, then I think Neil Dutta would be right. This would be someone who would be a Fed chairman in name only.
I want to also point out that we have economic data this week, inflation, print, CPI. What are your expectations? We had Stuart Kaiser a little earlier on the show talking about expectations that if it comes in cool enough, that you could actually see a pretty drastic change in market pricing for that September rate cut. Do you think that that's a near possibility? The market's only pricing in just over a 60% chance right now of that cut. So that's a pretty dramatic move.
Yeah, so looking ahead to the data this week, we're expecting actually to see a relatively core CPI print. We're expecting just 0.15% for the core. The consensus is at about 0.3% for the core. So that cool CPI print could be enough to get a little bit of a higher probability of that September rate cut. I think that once we then see the PPI data and then map to PCE inflation, which is what matters most for the Fed, I think that some of that pricing might retreat. Even though we're going to get a relatively low core CPI print in our view when we sharpen our pencils, we think that we're going to see something more like a 0.25% month-on-month core PCE inflation reading for the month of June, and that's not going to be favorable if you're thinking you're going to get a September rate cut. So ultimately what it will come down to this week is going to be retail sales, and I think that if we have a relatively favorable, say 0.2 to 0.3 control group reading for retail sales, pricing's really going to retreat for September.
I think maybe the one reliable thing is that whatever comes out, you're going to get some comments on X from Washington, D.C. to start cutting.
Potential volatility, too, given
I think that's right.
print by print disparities, if you will.
Yeah, absolutely. Hey, Stuart, we really appreciate your time this morning. That is Stuart Paul of Bloomberg Economics. Coming up, the market-moving events that you need to keep an eye on this week. We'll give you your trading diary coming up on Bloomberg Open Interest.
Now, a look ahead at what's going on this week. There's a lot going on. Tomorrow, we get the latest inflation print with CPI data. And Danny, CPI is interesting alone because market expectations vary. And if you get a really cool read, like Bloomberg Economics expects less than 0.2%, then the market could really take off in terms of bond price movements.
Yeah, at the moment, it is 0.3% month over month that is expected. If you get something like 0.2%, is it a White House that steps up their calls for a Fed chair that needs to quit, that needs to step back, and then conversely, do you get higher bond yields because of that, even with cooler CPI?
Kind of strange. Now, higher bond yields leads me to bank earnings. That's also starting off tomorrow. JP Morgan, Wells Fargo, Citigroup kicking it off. Wednesday, you have Goldman, Morgan Stanley, and Bank of America. I'm keeping my eye, Danny, on the rat race because, of course, we're going to be watching not just how much they make, but who's relatively making more, particularly in those core Wall Street businesses that are coming back, M&A and trading.
Yeah, I want to see just how much those are coming back. Right? It's been every quarter so far this year, which there hasn't been many. But when they say it's coming back, M&A environment will be better. And we are still not there yet. Are the animal spirits finally coming back with hopes of deregulation in the second half?
The setup is such that JP Morgan is trading at the richest valuation of the big three investment banks, Goldman the cheapest. Let's see if we get some reversal. But it's not just about earnings. We have more economic data. Interesting, Stuart Paul saying that actually the retail sales on Thursday will be really important to watch. And also, I think this one's going to be so fun. Netflix earnings on Thursday. Remember, Netflix is not part of that big Mag 7 group, but has just been stunning Wall Street over and over. They have had a really interesting slate of content. Let's see how they tend to kick off the earnings season for the big tech giants as well.
I think any of these consumer names are also really interesting. Amazon, a record Prime Day. Delta, you mentioned this earlier in the show. Their bookings stepping up for the second half of the year. Netflix, maybe it'll confirm that this is a consumer that is not afraid to keep spending despite a lot of the uncertainty.
But also, of course, we're going to be watching for that K-shaped recovery. Let's see if there's going to be divergence between pieces of the group here when they come out to report. But coming up tomorrow, who we have is Baird's David George on the banks, Morgan Stanley's Andrew Slimin used to be a bull. Let's see if he's a little bearish now. Kristen Roth-Clark of Barclays on the outlook for tech M&A, IPOs, so much going on. Danny, nice to be with you today.
Thanks for having me, Sonali.
You got it. Stick with us for the rest of the close. This is Bloomberg Open Interest.